I think that I think the Fed screwed up by allowing it to the zero interest rates to go on for too long. I think we're just beginning to pay the price for that.
The market is divided in its opinion about soft landing versus hard landing by the Federal Reserve. The market is euphoric starting 2023, with an impression that the inflation is slowing down, and the Fed will start lowering the rate. To some, this is not the case, and the possibility of a recession for the US economy is still strong. One of them is billionaire investor Sam Zell, who thinks the economy has to pay for what the Fed did with low interest rates for so long, before the market can be optimistic. Watch his full interview at the end of the video. In the soft landing scenario, the inflation is tamed and coming down consistently, and not as many people lose their jobs as expected. Last month, at the Davos event, many CEOs were saying that the situation perhaps is not as bad as they anticipated in the latter part of last year. January CPI report shows inflation rate slows to 6.4% over the past 12 months. The January job report shattered all expectations, adding more than 500,000 jobs, putting the unemployment rate at 3.4%. Market reacted to these positive news with a lot of optimism, and rallied since the beginning of the year. On the other hand, a hard landing is when Fed tightens so much that it creates a recession, unemployment goes up, people lose their jobs, and people can't afford things to buy. In that scenario, the inflation still comes down, but the people don't have the money because of their unemployment. In such spiral, the economy may slow down so much that the Fed even have to pivot. Many are hopeful about Fed can engineer a soft landing, but there has been a lot of liquidity supply in the market over the last decade, where the Fed basically left the interest rate to zero. The inflation rate may be coming down, but at the current rate it is still very high. Although the latest inflation rate shows it may have slowed down and peaked, but it is not showing any sign of returning to Fed's 2% inflation target. And if the Fed wants to achieve that target, they need to keep hiking the interest rate longer than they anticipated. The Core Consumer Price Index, which strips away volatile food and energy prices, rose by 0.4% for the second month in a row. Shelter cost is still rising and rose by 0.7% last month. By all means, the current situation of the US economy is not as rosy as the stock market is hoping for. The market has been down for almost a year. Many investors in the current market have never seen a proper market pullback, or a bear market. Because, anytime the market was down, the Fed came in to rescue with free money. But this time, that is not the case anymore. The inflation is sticky, the interest rate is still too high, and all these, because the Fed screwed up.
Billionaire investor Sam Zell of Equity Group Investments joins me here at Post 9. It's good to see you.
Good to see you, Sarah.
So there has been a bit of a rethink in the markets about recession. Is that something you still expect?
I haven't gone through that rethinking.
You're still negative?
Negative is the wrong word, but when you spread out free money for years at a time, you create, significant drag, and I just don't see how we're going to avoid a slowdown as that whole process comes to an end.
Well, I guess the idea would be that the Fed would get really lucky and engineer a soft landing here because the data is strong, the labor market is super tight, and inflation is starting to come down.
Yeah, but is the definition of coming down going from 9 to 6?
Well, it's yes, and then it has further to go. Sure.
Well, but the point is 6 is a
still
serious
very high.
problem.
Yeah.
And
so you think the Fed's going to have to do even more than the market expects?
I think that I think the Fed screwed up by allowing it to the zero interest rates to go on for too long. I think we're just beginning to pay the price for that. And it'd be nice to say that it'd be great if the Fed got lucky. I've been around for 50 years, and I've never seen the Fed get lucky. All I've seen the Fed do is mistake in terms of not acting fast enough.
So how do you take that view and prepare some of your companies and your portfolios for that eventual outcome?
I think you basically do two things at the same time. One, you prepare for higher interest rates and higher costs. And then at the same time, you also prepare for dealing with inflation. So a year and a half ago, we went to our companies and said, hard to imagine we're not going to have significant inflation, and we need to prepare for it, not respond to it. So in effect, we reached out and changed a number of our policies to prepare our companies for escalating costs.
Are you now preparing for disinflation, or you're just not convinced it's there yet?
No, preparing for disinflation would be a very optimistic thing to do at this point. I think it's going to take a while for the inflation pressures to ease, and I think that's what we have to look forward to.
Sounds like you think the stock market may be a little too excited about this notion that inflation is coming down and the Fed's going to pause.
The stock market has a long track record of being too excited about everything, both negative and positive. And I think, when the stock market reflected the fact that interest rates were going up and inflation was a problem, it was a little slow to pick that up. And then at the first opportunity, the stock market has gone and flipped and said, oh, everything is wonderful, and we're going to have a soft landing. I think both those extremes are unsupportable.
What about real estate, which is a big business for you? It's what you're known for. How much is real estate off the lows, if at all? Because we have seen mortgage rates come down.
Yeah, but think about the fact that if you had bought a house in January or February or last November, your mortgage rate would have been 2%, and today it's 6%.
Yeah.
That's
still high.
That's a pretty staggering jump in a relatively short period of time, and I think there's just going to be, I think the real estate industry as a whole is got to deal with bullet loans and all kinds of things that were the result of very, very low, unrealistically low cost of capital.